Good afternoon, ladies and gentlemen. Welcome to our third installment of our Thematic Insights podcast here. We've got Stuart from Rize ETF. Stuart, why don't you give us a sort of brief introduction on yourself and so the audience can get to know you a little bit better.
Thanks for that. I'm one of the founders of Rize ETF. We launched this business in 2020. Previously, we built another ETF business, which is a significant player in the market these days. And we really we set out to launch Rize ETF because we could see this convergence coming between thematic ETF investing, which we as a group of people had really kicked off in 2014 with the launch of Europe's first robotics and cybersecurity ETFs, the convergence between that and sustainable investing. So we could see this kind of coming several years ago, and no one was doing it. So that's really what we set out to do with this. Obviously, we could see certain trends coming from certain areas of Europe, demand for this kind of convergence in thematic investing, and really that's what we do. So with all of our products, we're either investing in inherently positive and sustainable themes like the sustainable future of food, or our environmental impact theme, or we're investing in traditional thematics like cybersecurity or digital payments, etc., but through an ESG lens, right? So we have an ESG risk mitigation sort of integrated into our process. So that's sort of how we differentiate our two suites of products.
Got it. It's good that you touched on thematic and ESG, really. And just for the audience that don't really know what thematic and ESG is, ESG naturally stands for environmental social governance, and thematic are really looking at some of those secular trends and themes that are really going to be shaping the future in the next 5, 10, and so on, many years going forward. Quick question to you, Stuart, on Rize. Now, naturally, thematics and ESGs has really come to the forefront lately. How does Rize differentiate itself between some of the other managers that are also offering, ESG funds or ESG strategies, and especially on the thematic side as well?
So I think the thing that makes us different is we specialize in this. So what you have seen, and everybody has seen this in the last few years, is every asset manager, every large asset manager who doesn't have a legacy background in ESG or sustainable investing relabel themselves as ESG and sustainable experts, which just isn't credible, right? If you've not been doing it for a long time, you cannot just say you're doing it the next day and then be taken seriously. And that is exactly why we're seeing all these greenwashing scandals. It's not because these large asset managers and people do not have people who are well-intended working within their organizations. Of course they do. They've got, if you look at some of the ESG team members working for these firms, that they are very well-intended. The problem that you have with these big firms is you've got the ESG team sitting on one floor, you've got the legal team sitting on another, compliance sitting on another, C-level executive sitting on the top floor, and then the PM sitting on a totally separate floor. There's no cohesiveness in ESG integration, right? You've got the top down, the C-level saying we must be sustainable, we must be putting out products that do all that. You've got the marketing team who then get carried away relabeling things, and then you've got the PMs and the ESG and corporate governance teams who aren't integrated. So it's a recipe for I wouldn't say disaster, it's a recipe for greenwashing and misrepresentation of the process and exaggeration of the process. And that's really what's been undermining ESG investing. I always hear people say this, ESG is flawed and all these kind of things. It's not flawed itself. It's flawed in the way that it's being integrated and used and labeled. So that's the challenge. And for me, the most important thing is that when managers are labeling their products, they need to be labeling them correctly and then being transparent about their process. So what exactly are they doing to create the final output, which they label as either an ESG integrated portfolio or a sustainable portfolio or just a traditional portfolio, and then able to actually show you what's within that fund. which is what we're all about. So we are focused, absolutely laser focused on transparency. So people can see, if they go on our website, they can see our policy in terms of how we integrate ESG into all of our funds. And they can actually see the results of that. So they can see the full fund holdings every day, every single company that's in our funds, not just the top 10, everything. And they can also see our public exclusion list that we've applied to all of our themes, right? So, for example, with our Sustainable Future of Food Fund, we screen out companies that are involved in all kinds of things, whether that be meat production, commercial fishing, but then also all the traditional ESG screens. We have 14 categories of screen that we apply. And what we do is we take our full food universe, sustainable food universe, where you have a whole range of sustainability criteria kind of embedded, and then we push that through our ESG machine, and we then exclude all this stuff. And then what we do is we take the results of that exclusion process and publish it on our website, so you can actually see, oh wow, they do actually have a process here. These are all the names that have been removed and the reasons why they've been removed. And we're the only people, I think, that do that. And I think if you're doing something, you need to be able to show people what you're doing. And I think that is the big bit that's missing from all of this. And we can talk about SFDR and regulations and all these kind of things in a minute, which we believe are, going to really help change that over the coming years.
Mm-hmm. I think it's great you touched on greenwashing, which, let's be real, it's something that's afflicting the industry quite significantly, especially as you mentioned from some of those, larger players here in the industry that, like you said, they're trying to get more sustainable and more ESG, but it ends up going about the wrong way. One of the questions I had is, naturally there's the sort of negative exclusion element of ESG, where you just, blanketly exclude certain sectors and themes that, many people would commonly agree aren't the best when it comes to that ESG lens. But then there's also the positive attribution to it. How does Rize deal with that? And do you just focus on one or the other, or is it a blend of the strategy?
So this is back to the way that we sort of split our themes into two separate buckets. We have traditional thematics like cybersecurity, digital payments, medical cannabis, pet care. That's one of our newest ones. These are not themes that are trying to change the world for the better, right? They're not designed to be impactful for whether it be environmental or social. They are just trying to provide you with exposure to a growth area of the economy that we feel is exciting and has long-term sort of long-term support from various demographic change or other consumer change that we're seeing in the world. But we're enabling you to invest in these things through an ESG screen, right? So basically what we do is we say, look, yes, you want to invest in cybersecurity, but you just don't want to have exposure to the companies that are the bad corporate citizens, right? The companies that are involved in the development of controversial weapons, companies that are badly governed, the companies that have sort of ESG risks that could ultimately impact their value, right? I mean, if you have a company that's badly governed, you can have a director doing, dodgy things, and then it comes out in the news, and then the company's share price is impacted. You can have companies that are involved in things that are unsavory, certain activities, whether that be tobacco, whether that be adult entertainment, whether that be controversial weaponry or whatever it might be. So we're basically offering people the ability to invest in these themes, but through this ESG lens, which is a negative screening process, right? And that's where we see it. It's an ESG risk mitigation tool. That's the first bucket. They're all Article 8 funds, ESG integrated. The second bucket of funds that we have is much more down the positive screening route that you mentioned, which is these are Article 9 themes that are designed to be inherently positive and sustainable, right? So we have two of those at the moment. We have our Environmental Impact 100, which is effectively investing in companies across renewables, renewable energy, energy efficiency solutions, and another of other areas like circular economy and things like that. And the idea is we're selecting the enablers of this transition to a cleaner, greener, more conscientious, I guess, mode of industry and consumerism. So, obviously all those sectors there are trying to sort of fix the wider economy, if you like. And then, so inherently positive. And then the other one, which our biggest fund and our biggest theme is the sustainable future of food. So this is another one that, again, is designed to be inherently positive and transformative for the world, right? There did not exist a public investment taxonomy for the transition to a sustainable food system. So we had to build that entirely from scratch. And one of the things we do with all of our funds is we build them all from scratch. We don't license an index from a third party like FTSE or Selective, which is what all the other ETF providers do. We build everything ourselves, which makes us very unique. And because of that, we're often treading into new territory every time we launch a product, and having to design something from scratch. So and I think the first thing to say is it always starts with research. You look at a sector like the food system, the food and the agricultural system. It is huge, right? It's one of the it is, for the first thing to say, it's the biggest industry that remains unpenetrated by technology on the large, right? So and it has continued to be so right through until now. It's very unscientific in terms of the way we grow food, and it's very unscientific in terms of the way that we use machinery and things like that to harvest the food. And also there's a number of sort of major statistics with that particular theme, which really highlight the I'd say the very unsustainable profile of the whole production through to consumption of the food system. So a third of all food is wasted, right? Number one. And if you're in a developing country, most of that wastage is happening at the production end, because they don't have where they're growing the food and producing it, they don't have refrigeration. They don't have the best infrastructure there. So if you're picking a bunch of soursop fruit or mangoes or whatever it might be, it's going to be laying out in the sun for a couple of hours before that little truck makes its way around the villages to collect it all and bundle it up. We're talking about, a lot of farms around the world are still small holdings, right? The majority of farms around the world are small holding farms. They're not these big, huge farms where, that we can see in the United States and South Africa and places like that, Ukraine and Russia. They are small little places. So it's very inefficient the way that food is gathered and then fed into the supply chain. So what that means is, in particular in hot countries, there's a lot of wastage. In the West, though, in the developed markets, the wastage is all happening at the consumer end. How much food do we every month throw away because it goes past the sell by date or the use by date in the fridge? It's incredible. And in developed markets, we've become it's a little bit vulgar if you really think about the numbers, but a third of all the food is wasted, and that's the end that it's happening at. So that's a major statistic. I think the other thing is, and this is the biggest thing, is when it comes to sustainable investing, the focus for the last 10, 15 years, 20 years has been on fossil fuels. It's been on climate change. And what's happened, and the reason for that, is because the food and beverage industries and the agriculture industries have lobbied aggressively for a long time to keep the scientific facts related to climate change and biodiversity loss related to food and agriculture out of the public domain. Right. So this has been a big thing. It's still happening. The meat industries, the dairy industries in Europe, the United States, South America, everywhere, Switzerland, and the EU have been heavily subsidized by governments. And we've got extreme levels of lobbying that have gone on to keep this out of the public domain and keep the conversation focused on fossil fuels and not straying into the food sector. The fact is, the food system, when you aggregate all of the greenhouse gas emissions attributable to human activities, so human-caused greenhouse gas emissions, whether it be methane, carbon dioxide, nitrous oxide, etc., a third of all of that, and when you're including fossil fuels and everything, a third of the total comes from the food system. Yet no one's talking about it. No one has been talking about it. And we were really the first firm that really sparked this conversation in Europe, and have been doing a lot of research and publishing a lot of information to try and bring this out into the public domain and override a lot of the sort of lobbying and everything else that's been certainly a collusion between lobbyists, and a number of other firms over the last however many years. So we've been focusing on, so a third of all human-caused greenhouse gas emissions are from the food system. Half of that is from the meat industry alone. Half of it. Wow. And yet we're not talking about it. It's literally the elephant in the room. And so, you know, what we're seeing are two sort of major opportunities here and tailwinds that are sort of driving this transition. You know, that you can talk about improvements in supply chain technology and all this kind of stuff to reduce food wastage, but actually the emissions that come from the transportation of food, that has basically dominated. When people talk about, oh, I'm doing my bit for the environment, they say, oh, I'll buy local because that will reduce. The emissions from transportation of food are so negligible compared to the emissions deriving from the type of food that you're eating, that it's literally irrelevant to the conversation. The emissions coming from the food system are all coming from the type of food that you're eating, not from how it's transported. It's far better to consume a piece of fruit or vegetable that comes from literally the other side of the world than it is to buy a locally produced steak. It's not even comparable. And we produce information on this and statistics, and it's all coming from the UN and independent bodies that are doing the research outside of the influence of lobbyists. It's pretty scary. And I think consumers are only now just starting to wake up to it because they're seeing these Netflix documentaries that are highlighting these facts. You know, Netflix, BBC, these are the institutions that have done the most to drive the change in the conversation, highlighting these things to the individual consumer. But it's health and environmental concerns that are driving, say, a move to plant-based diets and things like that. But really, that's the big elephant in the room of the food system. It's meat production. Biodiversity loss is caused predominantly because there's a loss of habitat. And the biggest driver of habitat loss in places like the Amazon in Brazil is beef production. And it's not just because they're putting in pasture for cattle, it's also because they're putting in the plots of land to grow soybean. And most of the soybean that's produced, 80% of all the soy that's produced around the world is used to feed animals, which we then cultivate for food. It's not used to feed us directly. So soy, you know, everyone says when they go to Costa Coffee or Starbucks, I'll have oat milk or oat drink, as they have to call it now, rather than soy, because soy is really bad. It's not the human consumption of soy that's the issue. It's the fact that we're feeding most of it to animals so that we can then eat the animals. So you have this double farming issue, right? You're having to farm the produce to feed the animals, and then you're having to farm the animals. So double the water, double the space that you need to grow the food. If we just reduce the amount of meat that we're consuming, then you're substantially freeing up land to give back to nature, and you're reducing the methane emissions coming from animal production and everything else. So there's a lot of misconceptions in the space. When you build a theme like this, you have to do the research. I think one of the things that differentiates us from everybody else is that we do this research. We build these thematic classifications for our, on a bespoke basis. It takes months to do. The food theme took us about a year end to end to develop it. Obviously, I have a background in a lot of environmental work and conservation, so that I brought a lot of that to the table too. But it still takes a long time to do the work. And when we look at some competitors, people have come along and tried to jump on the bandwagon, seeing the success that we've had with this theme, and they're launching things, and they've got companies like McDonald's in their top holdings. It's like, you do realize McDonald's is just selling beef burgers en masse, chicken en masse. The emissions from these things is just crazy, the scope 3 emissions. But the problem is, when you push these things through ESG data vendors and you compare funds, the ESG data is so weak. They don't take into account scope 3 emissions. If they did, you would see that Tyson Foods and JBS, these companies, these individual companies have got carbon footprints equivalent to entire countries. So JBS has got the same carbon footprint as Italy. It's almost as big as the UK. It's one company, right? Wow. Yet you're going to find this company in so-called sustainable food funds or food for biodiversity funds, or whatever people label them as. You'll see these, and they've gone and put an Article 9 label on it without having done any, not even the most basic research to identify where the issues are in the food system and should we really be investing in these kind of companies. And it's all going to come out at some point, but I think that's the big thing that differentiates us.
I think it's great what you guys are doing, and really bringing some of that information back into the public domain and engaging in that conversation again. I'm going to round up the topic here, and we've talked a bit about the ESG lens, especially on the sustainable food front. We've talked a little bit about thematics. Now, when it comes to the actual portfolio returns, which naturally some clients they want to have their cake and eat it too. They want to be voting with their feet. They want to be investing in these secular themes and positive impacts for the world. But how does that affect their portfolio returns, especially on sort of a more shorter term versus a longer term correlation to the markets? And does actually investing in ESG and thematics offer diversification in a wider portfolio?
So I think it's sort of back to the question of whether you're an ESG investor or whether you're a sustainable investor, right? Because they are two different things. So if you're investing in, you can invest in the FTSE 100 or the S&P 500 through an ESG lens, right? So you basically have an ESG set of exclusions that snip out certain industries that you don't like, whether it be fossil fuels or I don't know, military contracting and all these kind of things. You can snip all that out and be left with the residual. And that is an ESG strategy, right? You're saying what it is, and that's what it is. That is an ESG strategy of sorts. Or you could be investing in a low carbon strategy, which is basically looking at all the companies out there in the FTSE 100, for example, or the S&P 500, and selecting the best performers in terms of emissions, whether that be scope 1, 2, and 3, or really you should be looking at all of them. Otherwise, it doesn't really make any sense. But but what you're going to end up with is a tech portfolio if you do that, because they have no forklift drivers and forklifts, they've got no truck drivers and trucks, they've got no emissions, right? So you're just going to end up with a tech basket. So a lot of these low carbon funds just look like tech funds because it's basically pointing to the same thing. Whereas a sustainable investment is very different. A sustainable investment is you're looking to invest in the enablers of some sort of positive transition, whether that be renewable energy, whether that be sustainable food, or whether that be circular economy, or whatever these themes might be, even social things. So and there you're actually honing right in on very specific subsectors where you believe that there is meaningful change happening as a result of the products and services that the company is producing. So if you're a renewable energy company and you're producing energy from renewable sources, or you're producing the turbines or the solar panels or whatever that are going to be used by those renewable energy companies, these are all companies that are either operating within the renewable space or enabling the renewable power generation to happen. So that's what you would typically expect to find in a sustainable fund or an impact fund. We can use these terms interchangeably, and that's really what makes them different. Now, within that sphere of sustainable investing, again, you're not investing in the FTSE 100 or the S&P 500 where you have an ESG screen where you snip out stuff you don't like. Or you just focus on tech company because you want to have a low carbon sort of footprint. Here, you're investing in the enablers, right? But what you're going to find is that you're going to have a lot of small cap companies where their products and services are great. They're hopefully going to change the world for the better, but they might not have the best governance. Right? Because they're small, they might be recently IPO'd. They're not going to have necessarily the same degree of governance infrastructure in place. They're not going to have the same amount of ESG data in place because they don't have a big team of people hired just to fill in all the ESG questionnaires that come in from the ESG data vendors and the big asset managers. And what that means, if you look at the ESG data that's out there, is you'll see companies that have no products or services that are changing the world for the better, having a better ESG score than a company that's building wind turbines for the wind power industry, which is, and so you'll have an ESG fund. Yeah, you'll have an ESG fund where people, and this is the issue with the whole, and why people think that greenwashing is a thing, because they buy an ESG fund thinking, yeah, environment, cool, that's one of the main tenets of ESG. Great, I'll buy this fund, and then that means I'm sort of doing my bit. then they look into it and they see, hold on a second, I don't see any renewables in here. I don't see anything to do with sustainable food. I don't see anything actually that I expected. But that is a problem in the way that they are being advised. If they're an advised client, that is a problem that's feeding down through the chain. The product manufacturer, which typically a large asset manager, is putting the product out there, and in some cases they do a better job than others in communicating what's in the thing. But then the intermediary who's then reselling these products to their own advised clients or whatever it might be, they don't always do the best job in communicating what's under the hood. And so it's like I say, it's all about transparency, and this is what SFDR is trying to do. It's trying to say the product manufacturer needs to be really transparent. Okay, if you say your ESG, what do you actually mean by that? Is any of your portfolio aligned to the taxonomy, the EU taxonomy for sustainable activities? If so, please commit to a minimum percentage and then report on actually how aligned that is, every time you publish your financial statements. So that is going to force much better transparency. It's also going to force a real reckoning, because a lot of traditional asset managers and other ETF providers who've gone and stuck an Article 8 or 9 label on their funds are suddenly going, oh, crap, how the hell are we going to comply with this? Because we, first of all, don't have the data. We haven't built these products on a bespoke basis. We're licensing an index from somebody else. We have no control over ESG integration. How the hell are we going to comply? So yeah, I think there's a huge area to explore with all of this stuff. But those are the main differences between an ESG portfolio and a sustainable or impact portfolio. And that's, you're going to have that situation where you have companies that are, yes, Tesla's a very good example. They're a company whose products, are obviously all electric vehicles, and you can say that they're doing that. They can have a lot of impact, right, over time. Although you can get into arguments about whether electric vehicles actually do save on emissions and pollution and all this kind of stuff over the shorter term period. But then they've got bad governance. So it's like, well, so they might be an enabler, but they've got bad governance, so they're going to score badly with certain ESG data vendors in terms of their ESG risk, which is obviously a different thing. So it really depends on what you want to invest in, whether you want to just screen out the worst industries from your portfolio. That's an ESG integration. Risk management. Do you want to just have a low carbon version of the FTSE 100 or S&P 500? Again, that's an ESG risk mitigation of sorts. Although, if it's ESG, it needs to be not just carbon reduction. You need to make sure you're sniffing out companies with bad corporate governance and controversies as well. You can't just be one dimensional anymore, which is what a lot of funds have been. And then, or do you want to be a sustainable investor where you're not just investing in the broad S&P 500 or FTSE 100 screened, you're actually investing in the enablers of the transition, whether that be the green transition or the food transition, or which is a big part of the green transition, as we've discussed, or whether you're investing in social enablers. So that's where you have to sort of draw your line, I think.
Mm-hmm. Perfect. I hope the audience there found some useful insights there. Before we let you go, actually, Stuart, one question I had, which is, what's your favorite theme and why?
That's a really good question. So I've always been involved in kind of environmental projects my whole life. So I'm from Bermuda originally, so I spent a lot of my time in the water, and a lot of my time, on land, sort of growing trees and things like that. Last year, I was out there for a period of time, just trying to grow as many of the local palmetto trees and cedar trees as I could. And a friend of mine is actually clearing a couple of the national parks. And when I say national park out there, they're tiny, not like over here, but clearing them all of invasive trees. They're completely dominated by invasive trees. They look very green from a distance and very nice, but actually it's all, they're hugely problematic from a biodiversity point of view. There's no food there for the native birds and animals. So that's why he's trying to clear all that, and then I was trying to give him a whole load of trees to plant in there. But I've always been involved in these things, a lot of marine stuff as well, marine conservation. So that's my background and interest in terms of in terms of enthusiasm, what I bring to Rize as one of the founders. And so the food theme for me is I guess of particular interest to me, and I was a big part of building that alongside Rahul, one of the other founders, and then our environmental impact theme as well. I love it. It's what the idea of that is, we're not just investing in clean energy. We're not just investing in circular economy or electric vehicles. What we're trying to do is we're looking at all of those. We're taking the 6 objectives of the EU taxonomy, which is climate change mitigation, climate change adaptation, circular economy, protection of water. And we're combining all of those themes into one, and we're selecting what we believe to be the 100 most impactful names across all of those enabling sectors. So you could go buy a clean energy fund or a clean water fund or whatever, but they're very diluted exposures. The thematic purity is low. There's a lot of AUM invested in those themes now with people like iShares and stuff like that. So they've had to really dilute that thematic purity to be able to keep taking assets. So your exposure to the individual themes is heavily diluted. So rather than doing that, we can create diversity and make sure we have diversification in a theme by aggregating the themes together and then trying to select the most impactful names across all of them. So I do really like that one. I think as we keep moving forward, we're going to keep developing really unique products and themes like this, working with our research partners that hopefully will give people access to these sustainables. Again, we still do the Article 8s. We still build thematics with the ESG integration as well, because those are really great. And what we're trying to do there is be different to everybody else and give them that tool to invest in those exciting names, whether it be within pet care or within cybersecurity or digital payments, but through this ESG lens, so people can sleep easy at night. So yeah, we continue to do all of that as well.
Perfect. Well, this has been a great session, at least for me, and I hope some of our audience and clients found this useful and insightful, actually. But thank you very much for your time, Stuart. We really appreciate it. If anyone would like to check out Stuart's full bio or the details, they'll be down in the description. But other than that, thank you very much for your time, Stuart.
Thank you very much.